Speaking of coming together, let's talk about capital budgeting, a company's big decisions about where to invest their money for the biggest impact.
Right. The excerpts mention net present value, or NPV, internal rate of return, or IRR, and payback periods. These are the tools companies use to figure out which projects are most likely to be winners.
So it's not just about picking what sounds interesting, it's about strategically investing for the best possible return.
Precisely. For example, with NPV, companies aren't just looking at potential future cash flows. They're discounting those cash flows back to today's dollars using their WACC.
It's like saying, okay, this project might make us a bunch of money in the future, but is it worth investing in today given how much it costs us to get funding?
You got it. Now let's talk about something that can be both a blessing and a curse: leverage. The example they give in the excerpts, ROE probability distributions for Big B electronics, that really highlights how leverage works in the real world.
Because essentially leverage is about using debt strategically, right? Like borrowing money to try to make even more money.
Exactly. And just like you can amplify gains with leverage, you can also amplify losses. If Big B electronics hits a rough patch, those losses could be much larger because of the debt they've taken on.
It's a high risk, high reward kind of game.
You could say that. Companies need to be really strategic about how much leverage they use, especially considering things like how stable their earnings are and their overall risk tolerance.
Speaking of risk tolerance, the materials also mention a surprising benefit of debt financing the tax advantages.
Right, it seems counterintuitive, but those interest payments on debt are often tax deductible. So from a tax perspective, using debt can actually be more favorable than using equity.
Interesting. It's like the government is giving companies a little incentive to use debt financing.
In a way, yes. But of course, it's never that simple. Companies need to weigh the pros and cons carefully.
Absolutely. Now let's talk about how companies actually reward their shareholders, those investors who have put their money into the company. The excerpts discuss two main methods: dividends and share repurchases.
Right. Dividends are those regular cash payments companies make to their shareholders. It's like a thank you for sticking with us. Then there are share repurchases, where companies use their profits to buy back some of their own shares.
And when a company buys back its shares, it's like each remaining share becomes a little more valuable because there are fewer shares out there, right?
You got it. And the choice between dividends and share repurchases often depends on a company's specific situation, its financial goals, and what it thinks will provide the most value to its shareholders in the long run.
It's a balancing act, just like so much of what we've been discussing. Now, let's dive into those intriguing Arabic texts you mentioned. They offer some unique perspectives on revenue growth and how investor expectations can make or break a company's performance.
And a key concept here is total shareholder return, or TSR. It's a way to capture the full picture of an investment's return, both the increase in the stock price and those dividend payments we talked about.
So if a company is doing well, consistently exceeding those investor expectations, its TSR is going to be strong, right?
Exactly. And those high expectations can actually create a virtuous cycle, attracting more investors, driving the stock price up even further.
But couldn't that create a problem down the line? Like, even if a company is doing well, it can't keep exceeding those expectations forever, right?
Precisely. It's a good reminder that even for the most successful companies, those incredibly high expectations can be really hard to maintain.
And speaking of high expectations, the Arabic texts also delve into return on invested capital, or ROIC, which essentially measures how effectively a company is using its capital. And they highlight how much ROIC can vary across different industries.
Right. They make this really interesting observation about the life sciences and technology sectors and how they've had a huge impact on ROIC trends over the past couple of decades.
It makes you wonder what's driving that trend and if it's something we can expect to continue in the years to come.
Absolutely. Is it a temporary blip, or are we seeing a fundamental shift in the global economy?
It's giving me a lot to think about. And speaking of thought-provoking concepts, the Arabic texts also touch on the capital asset pricing model, or CAPM, that model we talked about earlier that's used to estimate a company's cost of equity.
Right. And they emphasize something really important. When you're applying CAPM in international markets, you need to consider currency fluctuations. They specifically mention using excess returns over the risk-free rate, which is a way to make sure those beta estimates, remember, that's how we measure a stock's volatility, are consistent, even across different currencies.
It's a reminder that financial analysis isn't just about crunching numbers. It's about navigating a complex world of interconnected markets and economic forces.
Exactly. And on that note, let's talk about strategic divestitures. The Arabic texts we've been discussing actually cite studies that showed companies that are good at divestitures, at selling off parts of their business, tend to outperform in the market.
It makes sense when you think about it. By focusing on their core strengths and getting rid of those non-core assets, they're essentially streamlining their operations and becoming more efficient.
Right. But the interesting thing highlighted in the texts is the importance of speed. Divestitures that happen within about a year tend to yield higher returns than those that drag on for longer.
It's like ripping off a Band-Aid. Just make a clean break and move on.
Speaking of making moves, the Arabic texts also introduce us to option valuation, a concept that often gets bogged down in complex jargon.
Options, in a nutshell, give a company a choice. It's the right, but not the obligation, to take a specific action in the future, like buying or selling an asset. The text use this great example of a company deciding whether or not to expand their factory in 5 years. Option valuation helps them figure out how much that flexibility is worth. It's like having a backup plan, a way to adapt if the unexpected happens.
Exactly. Now let's bring things back to some more fundamental accounting concepts highlighted in the Arabic texts. One that stands out is accumulated depreciation.
Which is basically acknowledging that those physical assets a company owns, their buildings, equipment, vehicles, they don't last forever. They lose value over time.
Exactly. And accumulated depreciation is simply how we track that decline in value on the balance sheet.
It's like saying, okay, we bought this fancy machine 5 years ago and it's not worth as much as it used to be.
You got it. And the texts even delve into the different methods companies can use to actually calculate that depreciation, which, as you can imagine, can get pretty detailed.
I'm sure it does. Finally, let's wrap things up with one more concept from the Arabic texts. Financial ratios, we touched on them earlier, but this example focuses on the cash ratio.
And the cash ratio is a big one. It essentially tells you how well a company can cover its short-term debts using just its cash and cash equivalents.
It's like a quick check to see if a company has enough cash on hand to pay its bills. Do they have enough to keep the lights on, so to speak?
Precisely. A healthy cash ratio is essential for any company's short-term stability and survival.
Thank you for watching. Stay tuned for the next video in the series. See you soon. Abdallah Aldriny, Chief Financial Officer.